Thanks for being patient with us as we get set up. My name is Jeremy Drews. I'm the regional manager for LendSure Mortgage. We are a non-QM wholesale bank headquartered in San Diego. We have local regional headquarters here in Salt Lake City, and we're happy to be joining you guys today and sharing some, hopefully some really good and new ideas that you guys can take back to your teams and to the field. Today I'm joined by three of our account executives. So to start out with, I want to introduce Brandon Kelderman. Brandon, go ahead and just introduce yourself briefly.
Hey everybody, Brandon Kelderman. Been in the mortgage industry for about 4 years now. It's been a blast. We'll keep intros short since we're a little behind on time, but one thing I do want to say is it's really cool this year to see how many familiar faces there are out there. I feel like I know all of you because the non-QM space has just grown so much that we've worked with a ton of you and looking forward to working with the rest of you.
Thanks. We'll next hear from Liv Barton.
Hi guys, I'm Liv Barton. I am Utah native. I grew up here in Bountiful, Utah. Went to school up at Weber State University, played soccer there for 4 years, and now I'm here. So I've been in the mortgage space for 2 years and looking forward to many more.
And then finally, Tanner Williams.
Hi guys, Tanner Williams. Also been in the mortgage industry for about 2 years now. I was actually a software engineer before that, so a very big switch for me, but absolutely loving it. And as Brandon said, looking forward to working with you guys and sharing some awesome information today.
So as I mentioned, I'm Jeremy Drews, I'm the regional manager. Just a little bit about me. I've actually been in the business since 2005. Depending on how long some of you have been in the industry, some of you may remember the name Accredited Home Lenders. We were a subprime mortgage lender going back to the mid-90s, and we went all the way through until about 2007, at which time we sold out to a hedge fund called LendSure, and then shortly after that we rebranded under LendSure. The 2015 date that's up here as a founding date actually is a little bit misleading in the sense that from about 2009 to 2015, we actually didn't have much of a secondary market to turn to for non-QM. So during those years, we actually did a lot of fix and flip business. We ended up doing some retail. And then in 2015, we were approached by another hedge fund by the name of Ellington Financial. They specialize in mortgage-backed securities. They approached us and said, hey, we think that the non-QM space is back. We want to partner with you guys. We want to be your main investor, and let's get this thing going again. So we shut down the retail side of things and reopened under LendSure Mortgage in 2015. As I mentioned, we're headquartered in San Diego, but we have offices all over the country. We have major centers in Rhode Island, Georgia. As I mentioned, our regional headquarters here is in Utah, just in Cottonwood Heights, in Missouri as well. We've been securitizing loans since about 2017. Every single quarter, we securitize anywhere between $300 to $400 million roughly in loans. Ellington Financial, who is not only our main investor, as I mentioned, they are also a parent company to us as well, which gives us a nice advantage to have some inside help to go directly to the investor for guidelines and exceptions and things of that nature that makes the lending process a little bit easier and decision making a little bit more nimble. So that's really good for us that way. As I mentioned, I came from Accredited, but most of our senior management team did as well. So most of us do go back to the mid-90s, 2000s in this space and in the lending world. So you are dealing with a very, very seasoned management team and lender here. And of course, we hope that you guys can lean on that experience here for some good sound guidance as you work with us. Currently, we are approved in lending in 48 states, as you can see here. All but 2 of them, which is South Dakota and New York, are the only ones that were not currently approved to lend in as far as owner-occupied properties. We can still do non-owner occupied or what otherwise known as business purpose loans in those states. But everywhere else, 48 states we're currently approved in and lending in. So we wanted to kind of bring a little bit more of a unique discussion to you guys today. And instead of just kind of, lobbing out, our programs and, telling you more about non-QM in general, we wanted to give, hopefully, you guys some new ideas that allows you to build pipeline, that allows you to go out and grow your business in some unique and ways that maybe you haven't thought about before. So to do that, we are going to talk about some programs, but there are going to be some unique programs that maybe you're not familiar with. And hopefully that opens up a new world for you guys to go talk to your agents and work with your agents and your borrowers about different lending ideas and programs that allow you to create a few more loans here and there and be a more value add to many of your partners, especially the agents that you guys are partnering with. So we'll start with those programs. We'll then next move on to some non-QM hotbeds. We want to focus on specifically some of the geographic hotbeds here in the state of Utah. Although this region that I covered does handle Idaho, Nevada, Northern California. We also handle many large national lenders as well, simply due because we were the ones that signed up those large national lenders, so we really are all over the country. But right here in our backyard, we really see some great hotbeds for non-QM that we want to turn to and talk about that allows you guys, again, to maybe rethink about your marketing strategy and your approach. Targeting property investors really seems to be a sweet spot for us. We'll talk about what we're doing there and what highlights maybe can stand out for you guys to go after that business a little bit more. We want to talk about exhausting all of your options before you turn down a loan. Certainly the easy answer is, hey, take a look at non-QM, but I think there's some specific ideas that we can introduce to you guys on some things to digest and consider and think about on how we might be able to restructure something and make something work before it's a turn down. And then finally, what is the opportunity to build a partnership with us? Where can we help you guys in unique ways that, again, is a little bit outside the box of your norms? So to begin with, we want to start out with talking about our bridge loan program, okay? That's one of the unique programs that we want to really highlight here today. So the bridge loan program, of course, as we know, is nothing new to the industry. Bridge loans have been around forever, okay? But we believe that our bridge loan program is very unique, and we're going to talk specifically about why it's unique and where there's really some amazing opportunities, and quite frankly, why it's probably our hottest program right now that we talk about. So to really get into the high level of the bridge loan program with LendSure, we're going to start off with Liv Barton. And so Liv, do you mind telling us a little bit about our bridge loan?
Yeah, absolutely. I'm super excited to get to talk on the bridge loan a little bit. It's one of my favorite programs to talk about, and hopefully here shortly it'll be your favorite program to discuss with your real estate partners too. But essentially how our bridge loan works, it's a short-term loan, so it's a 12-month balloon payment, but it enables borrowers to pull cash out of the departing residence, use it on the down payment towards their new purchase. So really the whole gist of it is to buy before you sell. If you want to go to the next slide real quick. So some of the reasons why people might want to do a bridge loan is one, it enables them to take their time accepting offers. Maybe their home is not moving as quickly as they thought, so just enables them to have that additional time. They don't have to do a fire sale and accept an offer for much less than they think they can get just to secure the home. It also allows buyers to make non-contingent offers. So if they find their dream home, they really want to get that house, they're going to want to make a non-contingent offer, and the bridge loan allows that borrower to do that. So that's another thing. With the bridge loan, they also, they're pulling cash out. So if there's anything that they're not using towards that down payment, they can use it, however they choose. So they can, do some renovation, they can purchase furniture, however they want to do that. It just gives them a little bit more cash out. And then Brandon, I believe you had some comments on that.
Yeah, I think really, so just to circle back, today's training and presentation is really more so to give you guys ideas on how to generate business with non-QM, right? So when you look at a bridge loan, talk about there's no better way to get into a new real estate office or to get back into a realtor that maybe you haven't worked with in a while than to give them a call right now and say, hey, how many deals do you have sitting around waiting for the borrower to close on their house because they have to sell their house first? The majority of the time when I talk to agents and ask them that question, they say almost all of them, right? First-time home buyers are much harder to come by when their rates have gone. So almost every buyer is a seller first, right? So that's what we're talking about when we talk about a bridge loan. Tanner's going to talk on the next slide about less than 2 years self-employment, but that's what we mean when we talk about unique programs and leading with those unique programs. Being able to go into an agent's office and talk to them about all these other outside-the-box options that you have to get more deals closed for them and for yourselves in today's market with how challenging it's been.
And so just a couple things to add to that. We originally created this program for what we thought was going to be a slowing market, right? It's taking 2, 3, 4 months to sell a home. Right? The borrower doesn't want to lose out on the opportunity to go get the new purchase, especially if that's their dream home, right? So that was the original intent, right? Let's get them their equity, let's get them some leverage right now to go make a non-contingent offer immediately and purchase that home, right? But what we end up seeing is in the hot market, it was even a hotter product. Why? Because simply the residence that they found was going to sell as quick as their own departing residence. So whether it took a week or two to sell, they didn't want to miss out on that other new property they found, that dream home that was also going to sell in a week or two. So it really does work in both markets, and if there's a geography that is still running pretty hot, versus one that's running slow, this is a really fantastic program to catch their interest and get them that equity immediately. Have them go buy the new house, right? Put in a non-contingent offer immediately, not have a payment until the previous departing resident sells, right? And really just kind of move forward with that dream home, right? So we really kind of speak to selling the dream with this bridge loan and not missing out on those opportunities. And there's also opportunities to do this with investment properties that we'll get into a little bit later. But want to focus on this for primary residences right now. So, Ken, anything you want to add to this?
You guys did a great job covering it. The only thing I'd tell you guys is when you initially pitch a bridge loan product to a borrower, there's going to be some initial sticker shock there of, closing costs, so I need an appraisal on both properties, costs, right? But those last three bullets there are really, really important for helping them understand that in a lot of cases, the costs are really mitigated by several factors, right? And it doesn't have to be, I'm dumping tens of thousands of dollars into doing this bridge loan. It can be, either a minor cost, or in some cases, borrowers even come out on top. They do the bridge loan, they end up with more cash in their pocket than if they hadn't done it in the first place. So it's a very, very strong program when you know how to properly position the conversation and have it with your agents and with your borrowers. And that's something we want to help you do, right? And we'll talk more of that as we go through this presentation.
And then finally, just again in the spirit of being a value add to the agents that you're working with, there's not a better way for you guys to be more of a value add than using the bridge loan for them. That's allowing them to obviously pick up a new property immediately, right, while listing and selling the previous departing property also and getting top dollar value on because they're not in a fire sale, right? So another way for you guys to really bring some added value to those agents. All right, so to move on to the next program and idea, we're going to have Tanner talk about how we handle brand new self-employed borrowers that many times on the conforming side, right, we lack the 2 years, and that's very tough to get those guys done. So let's talk about some ideas here with someone who literally has started a brand new self-employment type of position.
Yeah, so this is a great example of a program that is very rare to find, and a lot of your agents and referral partners just aren't going to know this type of financing exists. They've been around for a while, and they've had borrowers that recently switched to 1099 or opened a new business. You're not even going to get the scenario to cross your desk because your agents are going to say, oh, sorry, you have to wait to buy it, right? Or you have to buy in cash or something like that. So being able to provide this option to them, I'm not going to get into too much detail and go through all of these different cases, but the important thing to know is, when you have borrowers that switch to newly self-employed, we see this very often in the Silicon Slopes, which is something that we'll talk about in the next slide here with non-QM hotbeds. You have options for those borrowers for lending, and that's a great conversation starter with an agent. And again, leading with those unique programs and getting your foot in the door, right?
Yeah, my wife actually is a retail LO, so I see both sides of the lending world, right? She was on a team call a couple weeks ago, and one of her teammates was really frustrated about not being able to close enough loans. The comment that her teammate made was actually, gosh, I've had these great borrowers that have good income coming in. Their credit is phenomenal. Everything about them is right, but they've only been employed for a year or so, or even less, right? I wish we had a program for that. My wife had to speak up and say, hey, my husband's company can help with that, right? So there's so many different options to save these loans that previously were turn downs. Another example in that, again, is that self-employed borrower, they've just written too much on their tax returns and you're not showing enough income, right? Too many times we're seeing turn downs from the retail LO side when we can actually turn that loan into a 12 or 24-month bank statement loan and get them qualified, right? So just a few ideas here that kind of fall in line with the self-employed borrower. All right, so we're going to go ahead and talk again about some of these hotbeds that we see here in Utah. So to talk about some of the hotbeds, we're going to have Brandon start off with that one.
Yeah, so first and foremost, we've already just touched on some self-employed scenarios that we can get done. So really, when we're talking about non-QM hotbeds, the whole point of the conversation today is how do we generate more business with non-QM loans, right? So part of that is knowing where to look. So first and foremost, we live in Utah. We have a ton of resort towns. We've got Park City, we've got St. George, we've got Jackson Hole not too far, Sun Valley, Idaho, Las Vegas, which Tanner runs Las Vegas at this point. So raise your hands if you guys have heard of a condotel. Okay, 3 years ago, if I asked that question, a quarter of you guys would have raised your hands. So it's awesome to see the knowledge that people are getting now that there are options out there. But if you ask that same question in a realtor environment, a lot of them really don't know that there's long-term financing for condotels or know what a condotel is, right? So looking at areas like resort towns, second home destinations, short-term rental destinations, allows you to get into those non-QM hotbeds to utilize programs like a DSCR loan, which is an investment property loan with no income docs, right, which we'll touch on as well. It'll allow you to find more affluent borrowers, more wealthy borrowers with more money that maybe they don't have consistent income, but they've got millions of dollars in the bank. Why can't we use their assets to qualify for that loan, right? So when you look for these areas, you're really looking for those areas that have high self-employment rates. For example, Tanner mentioned Silicon Valley, there's Silicon Slopes that we have, right? Tons of new tech companies coming in, tons of new contractors that they're hiring. They were probably a W-2 contractor, they were probably a W-2 tech person prior, and now they're 1099. Why wouldn't we do a loan for that person, right? So the last thing I do want to touch on this slide too is thinking about the 1099 Career Professionals program that ties into what Tanner said about less than 2 years self-employed. Utah and Idaho are notorious for having tons and tons of self-employed borrowers, right? Their number one goal in being self-employed is to be able to write a lot off on taxes and save on taxes, right? I was 1099 and I loved it. That being said, when you start as a 1099 or a new, maybe you bought a new company, right? Or you bought an existing company, why can't we do loans for those people? So look for those areas like Lehigh, Utah County, Salt Lake, around the LDS hospital area. Travel nurses is another really good example that they're 1099 employees a lot of times, and maybe they were W-2 prior, and they just started as a travel nurse as a 1099, right? So again, I guess last thing too, I touched on second home areas and resort towns. So when you think about second home towns and resort areas like Park City, for example, average loan size in Park City's got to be close to somewhere around 1.5 million at this point, right? So you're talking jumbo loans at this point. One thing that comes up a lot, and I think Tanner's going to touch on this later is, why do I not do non-QM loans? Because the rates are so high, right? I like to remind people that you're not talking 12, 13, 14, 15% like hard money loans. You're talking realistic loan rates for borrowers that can't qualify otherwise, right? And in a lot of cases right now with second homes and jumbo loans with all of Fannie and Freddie's LLPAs, we're actually pricing better sometimes on loans in the non-QM space. So keep an open mind when it comes to rates and things like that, and just know that they're not all that crazy. And you can really put your focus into these areas with these hotbeds that have these self-employed borrowers, have nightly, weekly rental spots. St. George and Park City are right in our backyards to be able to separate ourselves and do more business there.
So a couple things real quick. I think it's a little bit odd for an audience member to look here and say LDS Hospital. That seems a little bit odd just right off the bat, right? The impetus behind that is we were working with a lot of brokers out in your guys' world, and many of those brokers were actually networking directly with hospitals and clinics and the HR departments of those hospitals and clinics and placing newly located physicians. Okay, in some cases, and in many cases, those physicians were actually transferring to an LDS hospital or another nearby hospital, not as a wage earner, but as a 1099. They were a wage earner for several years prior at the previous hospital, maybe even at the same hospital. But they decided it would be more advantageous, more financially beneficial for them to switch to a 1099 contract. They were actually going to make more money. Well, as soon as they did, they became newly self-employed borrowers. So we actually had many of the brokers reach out to us and say, we're looking for a solution for these types of physicians that they've been physicians for 3, 4, 5+ years making great money. They just became a 1099 because the opportunity is better for them. Can you guys do that somehow? And the answer is yes. We put together the career professional program to tie the same line of work together, get the 1099 contract to spell out how much they're going to make, and ultimately get that loan done, even with one pay stub in the brand new self-employed 1099 job. Okay, so that's the reason why we have a reference around some of these hospitals to look for some of these opportunities. Okay. The other thing I'll point out real quick, just many of you are probably familiar with a lot of these projects and properties in Park City. So when you look at a BlackRock, for example, many of you are familiar with BlackRock in Heber. That was a notorious project where many of those buyers were under contract for 2 years while it was under construction. In 2 years, the units came complete, and the conforming lender finally said, and the conforming underwriter said, sorry, we can't lend on these. I know you're ready to close, we can't lend on these. Why? The conforming underwriter, the Fannie Freddie underwriter is calling them a condo town now. Okay? So at the 11th hour, they were left, hanging the bag and going, where are we going to go with this? We ended up funding 25 of those units. Okay? So that's one example. The Pendry is another example. Okay, so these are opportunities, and we can talk on and on about Desert Color and other places in St. George and Las Vegas that we've done the same thing. So another opportunity for you guys to expand your business and your footprint in some of these areas.
One more quick story, Jeremy, for you guys, just to put it into context how much this can separate yourselves from other LOs. So St. George, Utah is a really good example. He mentioned Desert Color. So Jeremy and I got a phone call from an LO that I had never heard from. She's been 3 years now, but calls me and says, hey, I saw your website, saw you do these type of loans. We have all kinds of these condo hotels popping up down here in St. George. I want you to come down and present to the Washington County Board of Realtors. So what we did is we traveled down there, we did a whole day of presentations for all the agents in St. George, and I kid you not, immediately after every presentation, 4 or 5 agents coming up to us saying, hey, so you're telling me you can pull 65% cash out with no income docs on these investment property condo hotels that my borrowers have been paying cash for years? Well, I've got 12 of those right now we can do, right? So utilizing those things like condo hotels, like non-warrantable condos, second home rates, different income docs can really separate yourselves with these agents to where they're like, I'm not going to go anywhere else. All my loans are going to go here.
Thanks, Brandon. Okay, moving on to the next program, foreign nationals. This is something that a lot of lenders have actually bowed out of this space. We actually thrive in this space. It's something that we do quite a bit of loans at. We want to give you guys an idea of what the foreign national borrower looks like and what that loan really kind of looks like as we go through the process. So to take us through that, Tanner, give us a high-level overview of that.
Yeah, absolutely. So this is another one where you can build new relationships with agents who are primarily working with borrowers, coming from other countries and wanting to buy in Park City, right, to take advantage of the ski slopes. So we talked about that being a hotbed for second homes and for condo hotels and non-warrantable. It's also a hotbed for foreign nationals, right? So borrowers that live and work outside of the country that want to buy an investment or a second home here. And as Brandon alluded to with condo hotels, that's one of the highest rates of people owning in cash, right, is condo hotels, and it's the same thing for foreign nationals. You will find many, many properties owned free and clear by foreign nationals because they don't know that they have the ability to get financing, right? So the potential to cash out refi some of those, give them some money in their pocket to go buy, 1 or 2 more is another great way that you can build up your pipeline.
Thanks, Tanner. So, the obvious question we always get, well, what do you do about credit? They don't have U.S. credit. What do you do about the Social Security number? What do you do about income? They don't get tax returns and W-2s. How do you handle that? We don't need any of those things, okay? So the first thing that we start with is we get a foreign credit report. Every single country has their own version of our credit report. So it reports those trade lines, it reports their pay history. We get a copy of it, we have it translated to the English language and have it translated to the U.S. dollar. Okay, there's the first thing. We just want to know they paid. We don't use a FICO, okay? So we just want to know if they paid. Okay? If we can't get a credit report, we'll use reference letters from the financial institution that actually extended the credit to them. Social Security numbers, again, don't have those, okay? So what do we get? We get visas. Okay? We get visas, and in many cases, some of these foreign nationals have actually opened up LLCs from the United States, and we can use the LLC in lieu of a visa to even close in those types of properties as well, okay? Income, we actually use an income letter from either their CPA or the equivalent of their CPA stating their earnings history for the last 2 years year to date, or if they're a wage earner, then the company actually on their letterhead will actually state the income for the last 2 years in year to date as well. So those are the workarounds that we have in our guidelines with our investor to do these foreign national loans. And when you start to take a look at that, that's a pretty easy loan to do for someone who ends up having quite a bit of assets and actually really good credit. So another great opportunity for you guys to hopefully expand your business. Okay, the targeting of property investors, again, really seems to be our sweet spot, especially in this market. Of course, everybody is rate sensitive, seeing where rates have gone the last 12 months especially. But the one thing that we do see constantly is property investors, really looking at the rate saying, I can live with that because I still see the opportunity on cash flowing this property. I still see the opportunity of using short-term rents and an Airbnb and a VRBO on this property. I see the opportunity of the appreciation on the property, especially in these types of areas here in Utah. So let's go ahead and pull the trigger and let's continue to do these, right? So we really are starting to see more and more of these investment properties, flow in. And the nice thing about a lot of these investment property loans is that these are some of the easiest loans we end up doing, and we'll get into that in just a moment here. But to start us off with, Liv, why don't you take us through some of the high levels of building relationships with investors?
Yeah, absolutely. So investors are a great market to go after, especially when rates are a little bit higher. Investors are going to be that less, they're not as scared of high rates as say other borrowers might be. So it's a great place to go after. And the other thing is that they're not going to stop with one property. A lot of these investors, they are looking to purchase multiple properties. They want to establish a portfolio of properties, and a lot of times during these slower market periods is when they really can capitalize on the market. I mean, Brandon just closed 8 deals with the same property investor. I know Tanner has experience, with up to like 20 loans with one investor. So they're out there, and it's a great way to just build your pipeline. You're not going to just get one loan from this person. You're going to probably see multiple, and they'll be a repeat customer for years to come.
Yeah, and one quick reference, Liv says Tanner's done 20 with one investor. Brandon's done multiple. We don't have a limit on the number of properties that an investor can own, right? So when you guys start to get stuck at 10, right, that's when you can start to look at us. And some of these programs actually really align to somebody with multiple investment properties listed on their REO. And we've got a solution here that makes this really, really turnkey and easy for them. So Liv, go ahead and talk about DSCR and what that does.
Yeah, absolutely. So when you find these, big time investors, the best thing you can show them is DSCR. If they don't, if they haven't heard of it already, chances are most of you know what DSCR is. So it stands for Debt Service Coverage Ratio. Essentially, it's a, for investment properties, it's a no income doc loan. So we're just getting, the information, credit, application, asset statements, and we don't have to get any income docs. So really, it's minimal documentation. We don't have to have a completed REO schedule for other properties that they own. So if they own, 10 to 15 other properties, you don't have to get 750 documents showing, that REO schedule. But what we'll do is we'll order that 1007 market rents analysis with the appraisal, and we're just looking for the property to cash flow. So super simple. We do have the option to add interest only to these loans as well, so that helps us to lower the monthly payment, easier to qualify there. And then we also have the option to use short-term rents, long-term rents, a lot of flexibility with what we can do there.
Thanks, Liv. And then to hit on these last 4 bullets, I actually have a story for a borrower. It's actually the one they're referencing there with the 20 properties. So I had a LO give me a call, says, hey, I have a borrower that just sold a commercial property for a couple $1 million. It was owned free and clear. It was vested in the name of their LLC. So the 1031 funds were also in the name of the LLC. And you guys on the Fannie Freddie side cannot close a regular conforming loan using those 1031 funds because they're owned by a business. We can because we can close and invest in the name of the LLC, right? So what he did is instead of buying, call it 5 or 6 or 7 properties in cash, he came to us and bought 15, 16, 17, 18 properties with our loans, right? So he was able to make that cash go way, way further, right? Close in the name of his LLC, use those LLC funds, and it was very, very, as Jeremy mentioned, turnkey, right? We didn't have to worry about, oh, well, we just closed one, so now we have to refactor our DTI for the next ones, and none of that stuff, right? All we cared about is each individual property cash flowing, and it did not matter, the rest of the REO schedule. So we were able to get them done with very, very low hassle, right? Stretch that money a long way, and we're still able to take advantage of the full tax benefits with the 1031 exchange.
And so one of the things that makes it so easy to do these DSCR loans, especially for those that have multiple properties listed on their REO, is what we don't have to disclose. So Brandon, why don't you talk a little bit about what we don't have to disclose to make this so easy?
Yeah, and if you don't mind, go to the next slide so they can ponder that next slide while I talk about that too. So on DSCR, that Liv touched on that slide, the biggest thing is the ease of use, right? So one of the biggest things I talk to my LOs about is, let's say you have an investor that owns 10 properties, right? And they have 5 different businesses. So when they go to get a conforming loan on their next investment property, how many times have you guys had to go help them collect 750 different documents with all their K1s, their property taxes, their insurance, lease agreements on all the properties, right? On DSCR, to Tanner's point, all we care about is does the subject property pay for the mortgage payment with the rents, right? So what I want you guys to remember when you think of DSCR, there is no DTI ratio. Okay, DTI is out the window, it doesn't exist, okay, which is hard for a lot of us in the mortgage industry to think about, but DTI is gone, okay? We're not collecting income docs, we're not collecting REO docs on the 20 other properties that they own. Does the subject property cash flow, okay? So you'll see on the slide here how to calculate DSCR, and for simplicity's sake, it is pretty easy. all you're going to look at is what are our market rents of the property divided by our mortgage payment, okay? Now we have many ways on DSCR that we can get really creative with this, okay? So what you want is you want a 1.0 ratio. So for easy numbers, let's say our 30-year fixed payment is $1,000 and the market rents on the property are $1,000. 1,000 divided by 1,000 is a 1.0 ratio, right? Let's say your 30-year fixed is $1,000 and the market rents with the 1007 rent schedule and appraisal say the rents are only $950. Well, are we just stuck and we can't do the loan? Absolutely, we still can, okay? You have multiple options. We can add interest only, which then lowers the mortgage payment to that $950 or lower, and now we ratio, right? Investors love IO to begin with. I have actually had many investors come to us to refi out of a 4% interest rate to a 4.5% interest rate or 5% interest rate back in the day just to have IO, because what they care about is cash in their pocket now and the cash flow of the property, right? So IO is already an easy conversation with investors, but you can also use it to be really creative with it being a business purpose loan. I can ratio using the lower IO payment as opposed to a 30-year fixed, right? Yeah.
Sorry, I just have a question. So if they don't have any investment history, do you do 75% or is it always 100% of the?
Great question. So as far as DSCR ratio goes and the percentage of the rents we're going to use, it's always 100% unless we now can actually use short-term rental data on a 1007. So for example, I have a borrower in Florida, a national borrower actually, buying investment properties down there, and he's going to short-term rent them. So we ordered the 1007 with short-term rents, and then depending on what LTV you're at, if you're using short-term rents, the higher LTVs will use 75% of the short-term rents, which when you get short-term rents back at 19 grand a month, it's not really a problem, right? But when we're using long-term rents on a typical single-family purchase or something like that, we're using 100%. And then to your point, a lot of people think you can't do DSCR if you're a first-time property investor. You absolutely can.
The other thing to think about also is, we want to be proactive in the way we approach these DSCR loans, depending on what the property type is. If we know at the outset that this is a condotel, we already know this is going to be short-term rentals, and there's probably already going to be 12 months of Airbnb or VRBO statements that we can get and see what that history is, and actually use that in lieu of the 1007 even, right? So there's a lot of different things we can do, but bottom line is that if we know it's a condotel or we know it's nightly weekly rentals, we're going to source those even on the 1007. So part of what we do when we order the appraisal is we need to make sure that we also order the appraisal with the 1007 and get an appraiser that has experience sourcing short-term rents, okay? We don't want to get the appraisal back and find out that the appraiser actually sourced long-term rents and this is a condotel, right? So when we order the appraisal on the AMC we're working with, we're actually asking them, hey, please make sure you get an appraiser assigned to this that has experience doing short-term rents, that they can source this on the 1007, right? So those short-term rents go a long way. Like I said, when you look at BlackRock, right? Those BlackRock units were using the short-term rents, depending on the unit, those were bringing in $7,000 to $9,000 a month using short-term rents. A lot higher than what that mortgage payment is going to be, okay? Just as an example.
Yeah, and then the last thing I want to touch on DSCR for you. So far, we've kind of highlighted purchase DSCRs. One way for you guys to get loans in the door right now, Liv mentioned the fact that investors are still buying, right? But what investors are also really wanting right now is cash out of those investment properties, right? Whether it's because they've run out of money with where the market's been, or they want to go buy more, you can use DSCR for a cash out refinance, okay? So you run into these investors that have 20 different properties. It's not just a conversation of, hey, I can do a DSCR purchase loan on another one. It's a conversation of, hey, why don't we do 10 cash out refinances and get you a ton of money out and go do another 10 DSCR purchases, right? So investors are absolutely looking for cash out options on their investment properties, and DSCR is the easiest and absolutely quickest way they can do it.
Okay, so we're going to move on to get ready, buckle up, get your pens and notepads out. You're going to want to take notes on this one. This one's a little heady, but this is a good one. We recently were invited to present to Summit Sotheby's in Park City and Salt Lake. We were recently invited to present to EXP Realty and some others, and this is the program that the agents just would not let go. They just kept on asking questions. We were there for 2 hours answering questions. So going back to our bridge loan, I mentioned that we do these on investment properties. Now, to take out equity of an investment property to go buy a new investment property, that's pretty standard for a bridge loan. But the one thing that really that provides some power to these investors is combining that bridge loan and investment with a reverse 1031 exchange, okay? So to take us through that, Tanner, why don't you go ahead and discuss this?
Yeah, absolutely. This is one of our newer and most exciting programs. One thing to call out for sure is that every single investment portfolio in the nation is aging. And as they age, you're going to have maintenance costs shoot up, right? Things are going to go out. You need to replace an HVAC system, a roof, right? And it's just going to get more and more costly to maintain that property. So if you want to start swapping those out for newer builds, right, properties that aren't going to have as many maintenance costs, great way to do that is with the reverse 1031 exchange in conjunction with the bridge loan, right? So keep in mind this is going to work very similar to our bridge loan for owner-occupied, right? We're going to pay off any liens that are existing on the property, and our only loan on the old house is going to be our bridge loan, and that loan has no payments due on it. So what does that mean? That means your cash flow on that property is going to shoot through the roof, right? Where maybe you were close to breaking even before, we do our bridge loan, there's no payments due. Now all of a sudden you're collecting rents for 6 months with no debt obligation on that property outside of maybe an HOA fee, right? So the bridge is a 6-month term in this case instead of a 12 because the term for the reverse 1031 is also 6 months. And you know, investors more than anybody else are identifying, you know, the swings in the market, right? Trying to play when it's going to be high, when it's going to be low. So, you know, if they're able to do that successfully, they're able to buy now, right, when they can get a great smoking deal on a property, and then collect those rents, right, for 6 months on that old one with no debt obligation, and then sell when the market has swung the opposite direction, right, and they are selling it for more than if they had sold it 6 months ago. So it's an absolutely phenomenal program. You got all kinds of, you know, buzzwords right in this presentation as you talk to agents. And as we talked about with our owner-occupied bridge loans too, this cash out from the bridge is also able to, you know, put down a fresh coat of paint, replace some carpet, right, do some cosmetic stuff. It's going to go a very long way in getting that property ready to be sold and the new property ready to be rented. And get the most you can out of the rental income on the new property you just picked up.
So think about the power of delivering that to your agents. This is a unique program that, again, nobody else is doing right now. You have an opportunity to go out and give them something new and unique and drive some more business for them and have them pick up new properties that right now they're looking at their watch going, when's that investment property going to sell? When's it going to sell? When's it going to sell? Because I want to buy the new one, okay? So this gives you the opportunity to go and say, let's go get the new properties now. We have bridge loans, we have reverse 1031s that they don't lose the tax benefit if we do it this way, okay? So very powerful if you really understand this and take this to your agents, which then takes us to, you know, some of these other ideas here. So exhausting all of your options. Tanner, why don't you talk about some of the ideas here to, you know, consider before we let one go?
Yeah, absolutely. So we're running short on time, so I'll keep it short and sweet. But as Jeremy alluded to at the beginning of the presentation, you know, it kind of comes down to don't cancel a loan or turn down a borrower until you've at least had a conversation with your account executive, right? And run it past them, you know, see if there's something that they're able to get done because, you know, before you turn to hard money and say, oh, sorry, you're going to have to find someone else, I can't do anything for you, right? There's all kinds of new programs releasing every single month where, you know, we may have turned down the exact same scenario for you a couple months ago, but now all of a sudden we have something that we can do for you, right? Hybrid income is a huge one, so borrowers that, you know, are W-2'd and the ratios just aren't working, but then they have $500,000 in the bank that you can use as supplemental asset depletion income, right? Where maybe it's an $800,000 loan, so you can't do asset depletion by itself, you can't do W-2 by itself, but you can combine those income types and use a hybrid to qualify that borrower. There's a handful of things that we do with DTI where we look just a little more favorably. So I actually do a small handful of loans every year that are straightforward, full doc, W-2 loans. We're not using any special program or doing anything tricky. We're just able to get it to ratio, right? We're able to go up to 50% DTI. We're able to exclude some certain debts or deduct it from the income rather than hitting it on the debt column. So just a lot of different things that we can do. Student loans is another great example of those being deferred right now, where we can take them completely out of the calculation, right? So ask your account executive about your scenario, right? Sometimes I have loan officers that will turn down a loan to say, oh, well, you know, you went with another lender, and so your close of escrow is in 10 days. There's nothing I can do for you. You need a non-QM loan, right? Non-QM takes longer than 10 days. And that's not really the case, right? So a couple months ago, I closed 2 fallout loans in 7 trade days, 8 calendar days. So if you're turning down a loan because you're not sure you're going to be able to meet that turn time, have this conversation with your account executive first, right? And then trying to overcome objections. So, a very common one is cash to close, right? I don't want to tap myself out. I don't want to empty all my bank accounts or pull from my 401k or whatever it is. And so something that we allow that helps mitigate that is the ability to finance points into the loan amount, right? So you're upping your LTV a little bit. We're still going to price it and decision it as if it's at that lower LTV, but it's going to alleviate your cash to close. We can even finance it rate buy down, so it can put you in a better situation on your rate and your monthly payment. So when it comes to overcoming that common objection, the financing of points is something we can do that really helps.
Thanks, Tanner. All right, last two things real quick. Where's the opportunity to partner with us? We realize that a lot of this stuff is new. It's foreign to you guys. We don't expect you to regurgitate this to your borrowers, to your agents. So where's the opportunity? Well, here's a list of things, right, that we can, obviously help you with. The normal turn times and the things we talked about, right? The knowledgeability. But where we're really able to partner with you and help you, as I mentioned several times throughout this presentation, we've been presented. Yeah, question?
Just 1 minute.
Yeah, okay, thank you. So the opportunity really is to get us in front of your agents. As I mentioned throughout the presentation, that's really where we've been spending a lot of time, is getting in front of these agents and talking about these programs and educating them on this stuff. We encourage you to reach out to your account executive and have us do the same thing. Have us partner with you and be by your side as we talk about this until you actually have this information and really own it and know it. So there's the opportunity to partner with us and help you grow that business and that pipeline. And finally, the last comment here is we have all private resource labels and kits that we can help you send the marketing material and the slicks and the content out however you want to. Again, get a hold of your account executive. We actually have a website here, and there's also postcards that we'll be handing out with a QR code that has the location of all of this private label marketing, that you can actually make this marketing material look like your own program to send it out. So let us know what we can do to help you. Appreciate your time again, and everybody good luck out there. Thank you.